They wanted a silent night. On Wall Street, the plan was simple. Close the books, shut down the desks, pour the eggnog, and forget the silver market existed until January. Christmas Eve is supposed to be the quietest trading day of the year. Low volume, empty offices, nothing moves. But the market didn't get the memo. Today is Wednesday, December 24th, and instead of silence, we witness capitulation. Look at the screen. Silver is trading at $72.42, up nearly $4 in a single session, a 5.6% move on a holiday. That is not a rally. That is not healthy price discovery. That is a massacre. This is the sound of commercial banks surrendering. They tried to hold the line at $70. They failed. They tried again at $71. They failed again. And now, just hours before the market shuts down for Christmas, they are panic buying anything available just to get flat before the doors close. This isn't optimism. This is fear. And silver isn't alone. Gold has officially tagged $4,500. That matters. Because when gold hits levels like this, it isn't signaling growth. It's signaling currency decay. Faith in fiat is cracking. Suppression mechanisms are failing. And you are watching a historic wealth transfer unfold in real time. In this emergency holiday market update, we're going to break down exactly what just happened. Why the banks were forced to cover their shorts today of all days. Why $4,500 gold mathematically guarantees higher silver prices. And what to expect when markets reopen after Christmas. The gift has been delivered. Silver is at $72.42, and the squeeze is just getting started. So why today? Why would silver explode on Christmas Eve when nobody is supposed to be trading? The answer is risk management. Imagine you're a risk manager at a major bank. You're short millions of ounces of silver. Yesterday, price breaks $70. You're underwater. Now a long holiday weekend is staring you in the face. Markets will be closed, but the world won't stop. Geopolitical events can happen. Supply chains can snap. Headlines can hit while you're offline. If you go into a holiday holding a massive short position and bad news breaks, you don't wake up uncomfortable. You wake up insolvent. That risk is unacceptable. So the risk manager taps the trader on the shoulder and says, "I don't care about the price. Get me out. I want to be flat before Christmas." That's not buying because you're bullish. That's buying because you're terrified. This forced liquidation hits a thin holiday market, and the price doesn't climb, it teleports. Silver launches vertically from $69 into the low $70s in hours. That's the air pocket we've been warning about. No sellers, no liquidity. Just desperate banks racing for the exit before the doors lock. And this brings us to the elephant in the room, gold. There's been confusion, so let's set the record straight. Gold is trading at $4,499.96, effectively $4,500. This is the master signal. Gold is the clock of the financial system. When it reaches levels like this, it's telling you the dollar has lost purchasing power, and confidence in fiat is eroding. Now look at silver. At $72.42, the gold-to-silver ratio sits near 62. Historically, that's absurd. In 1980, the ratio hit 17. In 2011, it was near 30. Even after today's explosion, silver is still cheap relative to gold. If the ratio merely reverts to 30 while gold stays at $4,500, silver has to move toward $150. This is why the algorithms are buying. This is why silver is playing catch-up. This move isn't the destination, it's the rubber band snapping. And the speed confirms it. Organic buying grinds higher, short squeezes explode. A 5.6% move in a single session is the mathematical fingerprint of short covering. Sellers becoming buyers. Losses turning into fuel for the upside. And now the question no bank wants to answer. If they couldn't stop it at $70, and they couldn't stop it at $72, where's the ceiling? So the banks have surrendered for the day. Silver closes Christmas Eve at $72.42. Gold sits at $4,500. The bulls win the week. But now we enter the most dangerous part of the calendar. Traders have a name for it. The Ghost Week. It's the stretch between Christmas Day and New Year's Day, the period most people think is dead. They assume markets go to sleep. They assume nothing important happens until January. That assumption is wrong. Some of the most violent, explosive price moves in financial history have occurred during this exact window. Not despite the low volume, because of it. Here's why. During Ghost Week, the adults leave the room. Senior risk managers are skiing. Liquidity providers are offline. Trading desks are staffed by skeleton crews. The order book, the list of buyers and sellers, becomes dangerously thin. To understand what that means, imagine a packed stadium. One person shouts, nobody notices. That's a liquid market. It takes enormous force to move price. Now imagine an empty gymnasium. One shout echoes off the walls. That's where we are now. Instead of hundreds of contracts sitting at each price level, there might be dozens, sometimes fewer. So when a large buyer shows up, a fund, a sovereign desk, a pension allocator, they don't move the price slowly. They blow through it. If a single whale decides to buy silver on December 26th, they don't get filled at $73. They eat through every offer until someone finally says, yes. The result? Price doesn't climb. It gaps. Silver can jump from $72 to $75 in minutes, not because of news, not because of headlines, but because there's no one there to stop it. This is the holiday squeeze. And while the paper market thins out, something even more important is happening in the physical market. It's shutting down. Go to your favorite bullion dealer's website right now. You'll see one of two things. Sold out. Holiday delay, inventory unavailable. They'll tell you it's because of Christmas. That's true, but it's not the real reason. The real reason is risk. Bullion dealers operate on razor-thin margins. They sell you metal and immediately hedge or restock it. But over Christmas weekend, hedging markets are closed. Wholesalers are closed. Logistics are frozen. If a dealer sells you silver at $75 today and the price gaps to $1.80 on Sunday night, they can't restock. They eat the loss. So they do the only rational thing. They stop selling. Inventory disappears. The ask vanishes. Physical silver becomes unavailable at any price. This is a classic squeeze signal. When you have the currency but cannot exchange it for metal, the problem is no longer supply. It's confidence in money itself. If you already hold your metal, you're insulated. If you're trying to buy this weekend, you may not get the chance until silver reopens higher. And there's another force adding pressure: the calendar. January is historically the strongest month for precious metals. Why? Because new budgets open. Industrial companies receive fresh procurement allocations. Funds receive new inflows. Pension funds rebalance. Every trader knows this. So what do? They front-run it. They buy in late December so they can sell to January money at higher prices. This turns the final week of the year into a chase. Nobody wants to be short heading into new allocations. With silver already at $72, the market's year-end target shifts to $75. Traders want to paint the chart. They want silver to finish as the top-performing asset of the year. And they're close. But now we need to talk about risk. Market's close. The world doesn't. Gold is sitting at $4,500, a historic psychological line. If gold pushes to $4,600 while futures are closed, silver won't ask permission when markets reopen. We could see a Sunday night gap, the kind that traps shorts instantly. Anyone who sold at $70, hoping for a pullback, risks waking up to $74 with no way back in. This is why manic phases punish hesitation. You don't trade them, you survive them. So here's where we stand. Liquidity is gone. Dealers are closed, traders are front-running January, and the price is elevated in a vacuum. Which leaves one final group we haven't addressed yet: the people who don't speculate, the people who consume silver, the factories. In Section 3, we go inside the industrial panic, the off-market deals, the supply interception, and why miners may be the next leg of this trade. Now we shift focus to the buyers who don't care about charts. They don't care about ratios. They don't care about momentum. They care about one thing: supply. Because for industry, this price spike isn't a trade. It's a crisis. Silver at $72.42 isn't bullish to them. It's dangerous. Imagine you're the CFO of a major solar manufacturer. You built your 2026 budget, assuming silver would average $50. Overnight, it's $72. Your input costs just exploded. Your margins just collapsed. And your factories still need metal in January. This is where panic begins. Normally, industrial buyers hedge through futures. But right now, the futures market is unstable, illiquid, and violent. So they're doing something far more desperate. They're going off-market. Phones are ringing on Christmas Eve. Procurement departments that should be closed are active. Buyers are calling refiners directly. We need 10 tons of silver paste delivered January 2nd. The refiner checks the screen. $72.42 plus premium. The buyer hates it, but they pay. Because if they wait and price gaps to $75, they look incompetent. If they wait and supply vanishes, they lose their job. This is inelastic demand colliding with a frozen market. And here's the critical part. These deals never hit the exchange. Silver is being intercepted at the source. Straight from mine to factory. No COMEX, no London vault, no visible inventory. That's why this squeeze doesn't resolve quickly. Shorts can't cover metal that never reaches the warehouse. Now let's look at the other side of this trade. The miners. At $72 silver, primary silver miners are printing money. Their cost to pull an ounce out of the ground is roughly $20. Yesterday, at $60, profit was $40. Today at $72, profit is $52. That extra $12 didn't require new investment. It didn't require expansion. It flows straight to free cash flow. At these prices, miners are debt-free, cash-rich, and capable of massive dividends. But here's the disconnect. Their stock prices haven't caught up. Wall Street still thinks this is a spike. They don't believe $72 is real. They don't believe it will last. That disbelief is fuel. Because when the market finally accepts that $72 is the floor, not the ceiling, money will rush into mining equities. The catch-up trade can be violent. Indices can double in weeks when margins explode this fast. If you own physical silver, you're protected. If you own miners, you're leveraged. And leverage works both ways, but right now, it's tilted violently in your favor. Behind the scenes, a shadow market is forming. A battery manufacturer approaches a Mexican mine and says, "We'll buy your entire 2026 production at $75 flat." The mine agrees. Guaranteed profits. The manufacturer agrees. Guaranteed supply. And that silver never touches the public market. Every off-market deal shrinks visible supply. Vaults drain even as price rises. This is why higher prices don't solve the shortage. They confirm it. We're also witnessing a structural shift. For 20 years, corporations treated cash as king. That era is ending. Cash is now a liability. Silver is an asset. $1 billion in cash loses purchasing power. $1 billion in silver guarantees production. CFOs are starting to think differently. Strategic reserves. Inventory hoarding. Balance sheet metal. When corporations begin treating silver like a treasury asset, demand moves from millions of ounces to billions. And there isn't enough silver for everyone. So here's the scoreboard as we head into the final days of the year. Banks capitulated, industry panicked, supply vanished, price exploded. Silver is ending the year at historic highs, and the calendar is about to flip.